Hello, and welcome to today's Whitbread PLC full year 2022 preliminary results conference call. My name is Bailey, and I will be your moderator for today's call. All lines will be muted during the presentation portion of the call, with an opportunity for questions and answers at the end. If you would like to ask a question, please press star followed by 1 on your telephone keypad. I would now like to pass the conference over to Alison Brittain, CEO. Alison, please go ahead.
Good morning, everybody, and thank you for joining us today. With me, I have Hemant Patel, our new CFO, in his first outing as CFO, so welcome to Hemant. I've also got here with me Paul, Abby and Sophie from the Investor Relations team. I thought I'll just say a couple of words about the results before we kick off for Q&A, and then I will hand over to you guys to ask the questions that you want. Paul has asked me to comment that it would be really helpful, given we've got a lot of people on the line, if you could limit yourself to 2 questions initially, and then we'll circle back if we've got time at the end to add additional questions. So that's the key message. And let's just sort of kick off. Hopefully you've seen the RNS and or listened to the presentation this morning. So you will have seen that Whitbread's performance in the year was very strong, and our revenues and profits recovered exceptionally well from the previous COVID low year. Our hotels have been trading well ahead of the market, particularly in half 2 of last year, where we really saw that strength coming through. And then going on into the start of the new financial year, we're continuing to trade significantly ahead of the mid-scale and economy market, which itself, as you know, trades ahead of the whole market. And we're about 28% outperformance for Q1 to date. And my view is that good trading is driven by the actions that we've taken to manage commercial initiatives, but that is also helped by our strong appeal of our customer offer, our very large network, our strong brand, our direct distribution and operating model. We certainly have seen hotel trading in the UK remaining very strong as we've gone into the new financial year. We had traded above pre-pandemic levels, and we are continuing to do so. We're about 29% ahead of pre-pandemic levels. And we're seeing clear signs of recovery across all customer groups, so it's really quite broad-ranging. Leisure has been very strong and continues to be so. Tradespeople demand, as you know, was solid throughout COVID and has continued to trade well. But we've now started to see the return of office worker, white collar across the UK, and even seeing now signs of inbound back, certainly through website visits as a leading indicator. And in addition, London sales, which has previously lagged the regions, have now moved also ahead of pre-COVID levels and have come back up. So overall, that's a pretty strong position from a trading perspective on the hotel side. And our forward book position is encouraging into quarter 2. And then the final piece of good news is that our network planning exercise that we've recently done, we talked a little bit about a small sample for this last time we spoke, but we've now done a much bigger sample, about a third of the market we've now looked at, and that's showing clear evidence of an acceleration in the exit of independents from the market, which obviously gives us great opportunity to grow and has been one of the reasons for our success in previous years. We've continued to invest and invest well through the cycle, and so we should be very well placed to continue to gain market share as we move through the first half of this year and for the long term, given the structural change that is accelerating in our business. And the only note of caution there, which we highlight, is we don't have a lot of visibility into forward bookings for half 2. People are still behaving in a short lead way, and so it's like looking into fog for the second half. We just haven't got bookings on the books that from September onwards that we would be able to point to. Equally, we have no negative evidence either, but we have nothing to show in the second half. Couple of other points I'll make. Our restaurants business has come back strongly from last year, but still behind pre-COVID levels during the year last year. And the trends have improved in the second half and continue to improve as we've gone into the new financial year. And now food and beverage sales are about 5% below pre-COVID levels in the first 7 weeks of the year. I'll mention very briefly Germany, because I'm sure there'll be a lot of questions about Germany, but the restrictions in Germany have been around for deeper and longer in Germany throughout the COVID crisis of 2 years. And they have been a headwind in the hotel market. Now, they're largely been removed this month in April. I think there's still a few restrictions left in Hamburg, but most of the rest of the country is clear. But the market's still a bit behind pre-COVID levels and recovering more slowly than the UK. But notwithstanding that, as you would have seen in the presentation, if you've just been through that, hotels have traded in an encouraging way and have got absolutely stellar guest scores. And of course, in the last 2 years, during the COVID pandemic, we've transformed the German business out of all recognition. We've built an estate of now 37 quality hotels in prime locations across multiple cities that have got these phenomenal guest scores. So I'm really confident about Germany. I'm really pleased about where we've got to, and I'm looking forward to being able to trade that hotel estate without restrictions for the first time moving forward from now and then on into Q2 this year. A couple of other points just to note to bring out the sort of highlights. We issued increased guidance on cost inflation for the year. Now it's about 1% higher than we previously guided at about 8 to 9%. You'll have seen lots of media attention this morning on inflation levels because other companies have come out and announced significant inflation issues. We'll continue to monitor what we've got closely. We think that's about right for now. And we, as you know, work hard to offset the majority of that through a combination of a cost efficiency program. The fact that we've added 30 hotels in the last year and we'll add more this year, and our estate growth helps. And then we've got quite a lot of pricing flexibility, and you will undoubtedly have questions about that as we go forward. As we're moving into what I'd call the next phase of COVID recovery, and I think we'd have to accept that, like for like RevPAR has in fact recovered rather than being something that's going to recover. And as we've had a really good performance and a bounce back this year, and we're quite confident in the group's outlook going forward, particularly strategically in the medium term, we're able to restore the dividend, and the board is therefore proposing a dividend to be payable in July. And I'll just finish by saying, although I have been talking about the short-term results from last year and into really the first half of this year, we must really always ground ourselves back with Whitbread into it having a long-term strategy, and a clear one at that, to create value. We are growing in the UK. We've got at least a runway of a third again for growth, and we're innovating with new higher yield products like Premier Plus. And we've got a great path for that growth. And in Germany, we've built a platform that I think is now a very valuable platform for the future. And we're still developing our capability to support that growth in the long term. And I will very briefly just say one of those capabilities is, of course, our people. And during the course of the last year, our people have really stepped up. The operational environment has been challenging, and the delivery has been exceptional. And my gratitude and thanks goes to everybody in the business for the work that they've put in and the dedication they've had to make these results possible. On that note, I'm going to hand over to Bailey, who's going to take us through Q&A. So please do ask questions.
Thank you. If you would like to ask a question, please press star followed by 1 on your telephone keypad. If for any reason you would like to remove that question, please press star followed by 2. As a reminder, if you are using a speakerphone, please remember to pick up your handset before asking your question. Our first question today comes from Jamie Rollo from Morgan Stanley. Jamie, please go ahead. Your line is now open.
Good morning, Jamie.
Good morning. Morning, everyone. Thanks for taking my questions. Just two. First, is there any steer at all you can give us on the shape of the year in terms of RevPAR? I know you don't like talking about RevPAR too much, but the last couple of weeks are clearly, stellar, up around 20%. It looks like. I saw the slide you showed on strong pricing for Q2. You talked about white collar inbound coming back, independent exit rate accelerating. Is it implausible for RevPAR to be up double digits for PI this year. I appreciate not much visibility, but just thinking about the sort of boundaries there. And then on Germany, that loss of 60 to 70, what RevPAR assumption is behind that? Because the last 2 weeks are a lot better. I appreciate Easter's there. If you could help us understand the sort of the assumptions behind that, that would be very helpful. Thank you.
Okay, that's good. Well, yeah, shape of the year. I mean, we're pretty confident we're having a really good quarter one, and we're mostly through it. We're 2/3 through quarter one, and people are shortly booking, but what we can see ahead, we've got about maybe a quarter booked for quarter two, but less for half two, and that's where the opaqueness comes. But in terms of RevPAR, we've got strong pricing going through and sticking, and very strong demand. And I do think all of the demand drivers are now coming back or have come back and are in strong growth. And the last of them really is inbound. And what we're seeing on that is a lot more website visits for inbound travellers, which is usually the lead indicator, and they're back to almost pre-COVID levels now. So I think even that last piece, we will see some green shoots. It may not be fully back this year, but we'll see some of it. But across the board, otherwise, it is a very broad recovery. I'm sure some of it, Jamie, is pent-up demand. There'll be a lot of weddings this year. People have put things off. There'll be a lot of people wanting to go to events. And there'll be, I suspect, some still good staycation activity this year, which again, if people have got questions about, we can talk about. So I do think, what we can see at the moment is strong. Our only caveat to it really is the fact that we just don't have the visibility in the second half. And of course, there's lots of commentary out there about will the squeeze on the consumer, led by this inflation, lead to either them, pulling in their horns because they don't have money and cash available, or because their confidence level is lower and therefore they are saving for the proverbial rainy day. Historically, we've not done badly in those circumstances because people tend to trade down into Premier Inn, but without the visibility of a forward booking profile into half two, it is really hard to call. And so what we are calling out here is that there are uncertainties, and everybody has to sort of make their own judgments on those uncertainties. But certainly, I can foresee a strong RevPAR shape for the year in the UK. So from a Germany perspective, Helen, do you want to kick off with that? But then I wouldn't mind saying a little bit more about Germany. And I know I have a highly confident tone, but I have just spent quite a bit of time out in Germany over the last few months in both the north and the south of the country, and it really is looking very impressive. So you kick off.
Yeah. So so Jamie, the outlook at the moment for us is we've said that we think there's a 60 to 70 million pound loss in Germany, which is the same as the pre-grants position from the previous year into 2023. The assumption on RevPAR in that, if you remember as we were coming to COVID, we talked about getting to a £65 RevPAR in Germany. We're assuming about half of that, and at the moment, and that's for two reasons. One, because the market is sort of recovering. The restrictions in Germany have only just opened up. After we talk about our view in terms of and our confidence in the German market, but it is early days. The German market has been roughly 40% behind 1920 levels over the last few weeks, although it doesn't look like it's picked up this last week. So we're making an assumption that will take some time to come through, but obviously it could be a lot quicker than we expected. It could match what's happened in the UK. And then the other factor is delayed maturity. We've got a very new estate. Literally, we've got sites that are very new, so they're just starting maturity. But also a lot of the rest of our estate has only just started to trade. We've had the sites open for the last couple of years, but trading hasn't really happened yet. So that's giving another kind of like half of that impact in terms of delayed maturity overall. So roughly half is the answer to your question.
Yeah, so we're being suitably prudent, as you would expect, because the market has been really back. And the recovery has been, there've been restrictions in Germany for a lot longer. than we have at each time there's been an outbreak. It's lasted longer, it's been deeper, the restrictions have been tougher, and they're only just lifting now in April. And so clearly that doesn't give you a big line of sight. And the market has been 40% or so back in the last few weeks, but that has started to bounce this week, and now it's maybe 25% back. That's at market level. So you can see the market coming back, and I do think that Germany will experience the same sort of bounce and the same sort of levels of pent-up demand as we've experienced in the UK over the course of the few months. It's just how fast will that come back, and will it be as quick as the UK was during the course of last year? So I'm pretty confident that over time this year the market will return in Germany to strong levels again. And what I'm really also pretty confident about is that our German hotels are really very, very good indeed in the market. Our product is really excellent. I mean, anybody wants to go and visit, I'm sure we'd be delighted to show you around because we're so proud of it. We've got 37 hotels that look and feel a significant step ahead of the market competitors, our direct competitors. And they're in prime locations. They're across multiple cities now, so we have the opportunity to start really building the brand in Germany. And I think they'll do really well. And then they're efficient to run and to manage. And we've got a great team in Germany who are running them. So overall, I'm confident that over time we're going to see good performance in Germany. It's just the speed with which that might come back through the market and demand coming back this year that is our note of caution at this stage. Is that helpful, Jamie? Quite a long answer.
Yeah, very much. Yeah, very, very helpful. You did mention staycations earlier, and just to pick you up on that, are you seeing any sign of weaker staycations this year due to more international travel? And just in Germany as a follow-up, you've given us guidance to break even during next year. When might you give us some profit targets, if that's not too premature? Thank you.
Yeah, we've no issues with staycations this year. I mean, our business isn't predicated on bucket and spade holidays. As you know, it's a relatively small percentage of our hotels are coastal. So it is the broader leisure market that we are seeing is very buoyant. And obviously, because we're at the start of the warmer period now, I suspect we'll now be seeing the coastal areas and seaside towns booking. I think there's a lot of demand to go round. I think we will see increases in people travelling overseas, but as we know, there's a constraint on the capacity in overseas travel through the airlines. The cost will probably be quite high, and people are possibly thinking about whether they can afford that high-priced holiday and might stay at home instead, or they're also thinking about the disruption that there is and the Ukraine crisis and war being pretty close. And all of those things, I think, will make for a buoyant staycation year, as well as people returning to overseas travel at the same time. I think there's a lot of pent-up demand for both. So yes, not seeing anything that's of concern at this stage. But equally, as I said, we're not even half booked for quarter two. So we've got a long way to go on bookings. But what we have seen is the pricing has stuck, and so the pricing that we've put through, which we put through for the year, is sticking. And I always think the best way to also think about that pricing for us is, our average room rate in the UK is 60 quid, just a little bit over 60 quid. Even with a 10% price range, that's a pretty good value offer. And certainly, less than £70 a night is still a pretty good value offer for a quality Premier Inn room. So that on that basis, although the price increase might sound a high percentage, actually in real terms, it isn't a huge amount out of somebody's pocket.
Okay. I'm just picking up on Germany break-even. Clearly, a lot of our more mature hotels are actually on a unit level getting close to profitability, and we will do relatively soon. We've also, just a reminder, we've got a lot of expansion costs within the central cost base in Germany at the moment. Looking at the kind of fully loaded P&L, it's difficult with the uncertainty that we've got in terms of how quickly that German market's going to come back, and inflation to give you a specific number. But we are talking about getting to a break-even run rate in 2024. So slightly lower than what we said before, but it does very much depend on what happens with that recovery in the German market.
Yeah, and what you'll have seen, I'll just add to it, just because I am quite upbeat about Germany. You'll see that we've had 12 more mature hotels, and it's been quite a strange market to trade in over the course of the last 12 months. But 12 hotels that have been open a bit longer, and you'll see that we did trade above the market level in those hotels. There's a chart in the pack on that subject. So again, I'm quite confident about our ability to trade in Germany with a really high quality product and to make inroads as the market recovers. To be honest with you, Jamie, we'll be reporting again in 6 or 7 weeks' time in June, which will be the Q1 results, and obviously we'll have a line of sight both into the summer in the UK and through the summer, and in Germany we'll have had another 6 weeks market trading and market rebound, so we can talk about it in a bit more detail then.
And just to supplement that as well, obviously we're still very clear that in the longer term we expect to get to the group return, so 10 to 13% ROCE in Germany. We're still very confident about that.
Thanks.
Thanks, Jamie. It did not escape my attention that Jamie snuck in a third question there, by the way.
Fourth, I think.
Yes. Okay, who's next?
Our next question today comes from Vicky Stern of Barclays. Vicky, please go ahead. Your line is now open.
Good morning, Vicky.
Good morning. I've got about 10, but I'm going to restrict myself to 2.
Thank you.
Just firstly on the outperformance. So I've picked up all your points in terms of broadly why you think you're outperforming the market. Just wanted to unpick though sort of what's happened there recently, because that was quite a big jump up in terms of your outperformance versus the market just in the last 7 weeks or so, and even to the back end of Q4. What's driven that, do you think, and sort of sustainability of that, I suppose, as you look out into the next quarter? And then my second would just be around property. Hemant, obviously you talked in the presentation about not a load of transactions out there, but the little that you have seen kind of reflect back on the previous revaluation of 2018. Just what are you thinking about in terms of doing another property revaluation, sort of timing of that, and what form would that take? Same as last time in terms of sale and lease backs or something else? And yeah, just a reminder on your strategy with regard to property. Thanks.
Right. Well, I'll kick off with the first question about our performance, and I mean I think there's quite a lot of things going on. So, and we know that we're seeing supply leave the market in the form of independents, for example, and that being at a higher level. So undoubtedly there will be some underpin there for that. But broadly speaking, our outperformance is both on occupancy and rate. And, if you think about what makes up our performance, we've got, a higher occupancy level, we've got estate growth, where we're filling new hotels, and we've got higher pricing. And those three things packaged together, and have produced, we've loaded, I guess, got more confident as demand's returned, that our occupancies will be higher and that there is demand out there that is very strong, that is driving that higher occupancy. We have had estate growth and we are therefore filling our new hotels. And then we have loaded higher pricing because we need to pass some of that through. The market pricing is higher. So, we're not alone in putting through that higher price. And that is sticking and still driving high occupancy. So I think that's been the story of the first 7 weeks. And you say, is that going to be sustained? I think our general level of strong performance, I'm very confident about. In terms of outperformance of the market, well, the market coming back a bit, that more hotels will trade better, I suspect, particularly when inbound comes back, because I think inbound has really weakened London, for example. And we're going to cycle over periods where we already have high occupancy, versus last year. So, if in previous Q2s we've had occupancies of over 80, 85 or even 90%, we can't be more occupied than that. So it will then go to growth, filling new space that wasn't there before, and pricing. So that I think that sort of broadly gives you a picture of the makeup and what may come next.
And then on your second question, Vicky, regarding property transactions, clearly we're a 56% freehold approximate business, and the owner-operator model we run gives us many advantages in terms of full ownership of our customer, all of our customer interactions, and obviously there are covenant advantages to owning our property as well. We're keeping an open mind in terms of property valuation. As you said, there haven't been many transactions in the market really over the last couple of years, so it's probably not meaningful to do a full valuation right now. The last time the estate was valued was in 2018. We used an incremental sale and leaseback methodology, so kind of a careful sale and leaseback methodology, which is probably what we'd do again if we were to do so. That results in a valuation range of 4.9 to 5.8 billion pounds. As mentioned in the presentation, the transactions we see are generally in line where we're the tenant, are generally in line with the yields that we assumed in 2019, so kind of 4.5% to 5% overall, with a range depending on location and quality of the asset. So that, on a like-for-like basis, gives an indication that the valuations held up pretty well, despite what's happened through COVID. Obviously, we have grown the freehold estate in the meantime, so that would make a difference to the overall valuation. But right now, I think we'll wait and see and keep an open mind on it.
Thanks, Vicky.
Thanks very much.
Thank you, Vicky. The next question today comes from Richard Clarke from Bernstein. Richard, please go ahead. Your line is now open.
Hi, Richard.
Good morning. Hi, good morning. Two questions, obviously, is one I have. The first one just on CapEx. One of your competitors has talked about sort of a CapEx sort of catch-up program, having underinvested for the last couple of years. But your envelope for this year seems to be a return to pre-COVID levels, even though one would expect the sort of costs have gone up. There's still more hotels to open. So just some commentary around that CapEx envelope, what's included in that in terms of maintenance, and is there any kind of catch-up to come from the last couple of years? And then the second question, I know you've commented a few times on pricing already. You say you've not got much visibility into the second half, but how are you pricing into the second half? Are you sort of starting prices off assuming that the strong pricing so far will carry on? And given the strong pricing seen so far, do you expect any kind of longer-term changes to your pricing strategy? Are you going to move some of the caps that you've had in the past, for example?
Yes. So I'll answer that second question first because it's right front of my mind, which is yes, we're pricing strongly for the full year. So yeah, we are making the assumption that we will have strong demand and that the market strength of recovery will be there for domestic business and leisure travel and then a little bit of inbound as well. And we're pricing that accordingly. So yes, whilst we haven't got many bookings on the books for the second half, and that's not even pre-pandemic, that wasn't unusual. There's always breath holding in the summer because people tend not to book for the second half till they go back to school and work in September. Particularly business bookings sort of cease in August, and then you have the bated breath for the week after has the business demand recovered. So it's not actually that untypical. It's sort of slightly more pronounced post-COVID that people book more short lead. And of course, because you've got a market recovering, you yourselves are thinking much more hard about what that recovery will look like, as opposed to in normal BAU times when it is broadly speaking the same every year. So yes, but our assumption is that the market is going to be strong and that the recovery will be maintained in the second half, and our pricing strategy reflects that in terms of the increased pricing through.
Okay. And Richard, regarding capital, so over the last couple of years, we spent in FY22, we spent £260 million on capital overall. Around 90 million of that was UK maintenance and product improvement. Our intention is to take that back up to historical levels, as you said, 350 to 400 million pounds. We are going to be opening 1,500 to 2,000 rooms this year. It's more just really a question of the ebb and flow of the pipeline rather than any reason why that stepped down slightly. But, we expect to get back to 2,000 to 3,000 rooms going forward, FY24 and beyond. We have had some supply chain issues that have delayed that slightly, but we have full intention of taking our overall capex and refurb capex back to high levels. We've always spent a significant amount of money on refurb capex, so there's no need for us necessarily to catch up. But there will be a little bit, some supply chain issues that will unwind over this year and take that level back up again.
Because we were able to invest through the cycle and through the difficult period because of the strength of our cash flow, I'm sure we're not as far behind as others who've been off for 2 years and haven't spent a penny for 2 years. So I'm sure there is a little bit of catch up to do, and you're right, there's certainly some inflation in cost that we have to account for, but not like some of our competitors who probably just haven't spent anything for 2 years because they've been very cash constrained.
So just to be clear then, the kind of capex guidance for this year, you would expect that will probably go up again into the following year as you begin to open more rooms again?
Yeah, the timing of the room openings versus the capex spend isn't necessarily as fixed as that, obviously, as we're spending money to open rooms in the future as well. So it's not quite, you can't make quite that correlation. But as we said, is we'll get back to that kind of 350 to 400 million pound level going forward in the future, and obviously we'll continue to monitor that as the estate grows.
Thanks very much.
Thanks, Richard.
Thank you, Richard. The next question today comes from Bilal Aziz from UBS. Bilal, please go ahead. Your line is now open.
Hello, good morning.
Good morning. Thanks for taking my questions. Just the first one. You clearly talked about an acceleration of 3 times in the market exits, and I think you flagged that you expect that to continue in the next 12 to 18 months. So can you put that in the context of your market share aspirations now over the next 2 years? What do you think is a reasonable target and the return on that? And then secondly, just thinking a bit further ahead and beyond this year, can you remind us of the hedging policy you have on the energy side, please, and how we should think about that just moving ahead? Thank you.
Okay, yeah, so I think just to sort of recap a bit, when we last spoke, we had done a very small sample of regions in London and outside London to see whether we were starting to see a material churn in the independent market, and we were seeing evidence that was the case. We undertake this network planning exercise, which is quite a big deal for us because I think we're the only people who does it really. And we look at all the supply and demand that we expect to come into the market and go out of the market over the next few years. Looking at planning permissions and public statements from competitors and what we think Airbnb will do, but also looking then at the independents, which are very hard to monitor because most of them are very small single-owned businesses, and they don't report through STR data in the way that the big companies do. And in looking at whether or not they are leaving the market, it's slightly more complicated than just seeing that they're currently closed, which we can do off screen scraping from websites and phone calls to see. We also, of course, want to know that they're not going to reopen as something else later, or that they're just closed for a refurbishment, or they've been bought by another player and they're going to be refurbed and reopened and be a vibrant competitor. So it does take quite a long time to do this exercise, and we're about a third of the way through it with a relatively broad sample size within that third, so we can see what's happening across the whole of the UK and into London. And we think we are able, therefore, through that exercise to see that there is a decline in the independent sector that is significantly above the sort of normal run rate. And I think for those of you who followed us for a very long time, at the end of the last recession, we also saw an acceleration in the decline of the independents, which put us in a good space for growth. But it happened quite a while after that recession. People hung on, and it was a couple of years later when that really accelerated. I think we're seeing the acceleration now. I think we're seeing it has happened through COVID, and it's happening now, and we'll carry on probably for the next, as we said, 18, 24 months. That we'll continue to see that. So at the moment, it just the other picture is supply, and there is some supply growth in London. We think about 2% supply growth in London. There's not a lot in the regions happening at the minute. So, other supply and other entry. In fact, I'm talking about mid-scale and economy here rather than sort of overall market. And so that we were sort of relatively relaxed about that. We're growing, as you know. We put 30 new hotels in last year, and we've got 1,500 to 2,000 rooms going in this year. So we've got our own growth to go, and all of that combines to us being comfortable that we're going to have some market share growth. It's quite hard, however, to pinpoint it, and I'm not going to put a number on it. And equally, we will have been flattered in the last year or two in terms of really the gross market share position for us from a load of hotels being completely unoccupied or even closed during the COVID crisis. So at this stage, I don't think it's a stable number. It's certainly going to be an improvement on our pre-COVID market share, but I don't think I'm ready to call it yet as a specific number. Energy, how much?
Yeah. So, Bilal, we hedge across electricity and gas in particular. We're obviously very conscious of the utility inflation that's going to come through, and it's particularly been exacerbated since the beginning of the Ukraine crisis. We're 100% hedged for this financial year, FY23, and with 40% or just over 40% hedged for FY24, relatively evenly split across some electricity and gas. Clearly, we will continue to monitor that. We move our hedging position on season by season, and we'll continue to monitor the cost of futures, and that will move on as time goes on.
Thank you very much.
Brilliant. Thank you.
Thank you. Our next question today comes from Alex Brignall from Redburn. Alex, please go ahead. Your line is now open.
Good morning. Hi, Alex.
Morning, how are you doing? A couple of questions, please. There's an interesting comment on the call, the pre-recorded call, about using TripAdvisor, and I know you already use it, but have you had any thought about your stance on sort of transactional OTAs? A few of the other hotels have talked about expanding their relationships with the OTAs during COVID, and I guess some of them tie that into some sort of mix shift between business to leisure. So if you had a view on that, and then
just a sort of a minor correction there. It's a nuance. We don't use OTAs in our hotels, including TripAdvisor. The comment on TripAdvisor related to restaurants, which was when you get TripAdvisor reviews of restaurants, you can then click through to book a table in the restaurant, and I think that's the innovation the restaurant teams have put in. So it's not, we don't use OTAs at all within the hotel business, and we're not anticipating moving to using OTAs in the hotel business. We've weaned ourselves off them, and we've got the booking, the outperformance you're seeing from us is all done without anything other than direct distribution, except for a small amount, which is travel management companies, where, as you know, the people who book through a travel management company cannot be cannibalising because they're not allowed to book direct. So that's the sort of makeup of the distribution. Sorry for the confusion on TripAdvisor vis-a-vis restaurants.
No, that's really clear. Thank you. And then the second one, you said there's line of sight to 60,000 rooms in Germany. I don't know if you want to give more detail on that, given the competitive nature, but if you could give any more information on the kind of pricing that you're seeing on assets, that'd be really helpful.
Pricing on assets. But pricing on new, sorry, let me just get a grip on the question.
On potential assets. Yeah.
So, there's not been a lot of moves in Germany on asset prices, i.e. they've not got cheap all of a sudden. There have been, and we have been the recipient of some distressed assets. So, for example, our Centro Hotel purchase was a company that was in financial distress, and we were allowed there with them to cherry pick our preferred number of hotels from their portfolio, and we managed that acquisition not as an acquisition of the whole co, but as a individual negotiation with each landlord to transfer the assets to us with the consent of the current owner. and a small premium to them. So that sort of thing we have not only seen but executed against, and I think we will definitely be set over the coming months, given that the restrictions are just ending in Germany and therefore government grants and state aid will start to peter out and come to an end. I think we will see more of that, more distressed asset activity over the course of the next 12 to 24 months, and it will, that will occur. So that's my prognosis. Was there a first element to that question as well, rather than just the asset price? Was there something else you asked at the start, Alex?
Yeah, just any detail you had on how the route to the 60,000 number that you mentioned.
Oh, yes. So in terms of the original 60,000 number, I mean, that's still quite a small market share when you compare it to what we do in the UK. And just to refresh your memory on it, Germany's a bigger market, has more business and leisure travel, and is more fragmented. It's 73% independence in decline rather than about half in the UK. And so actually I think it's quite a conservative line of sight to 60,000 rooms. That would give us 6% market share, and we have double that in the UK. So we're not uncomfortable that is a prudent target to be had over the next few years. That may well then lead to a longer runway and growth thereafter. It would make us the number one player in Germany, and that's our aim.
Sounds good. And if I could ask a follow-up on that bit, how much of it do you think would end up having been new builds versus acquired hotels?
Hard to say. I mean, we've done plenty. We started organically, as you know. We've done a couple of acquisitions. Honestly, I don't know where we'd end up. It will depend entirely, I think, on what we see as becoming available in the market. Certainly, we're now, we'll build our own strong organic pipeline, which we like to do. We're well known in Germany now with developers. We don't have to sell ourselves or our covenants with developers in Germany. If there are opportunities, they come to us. So we've got much more opportunity to do both organic and inorganic as we move forward. We set hurdles. We're very disciplined about the capital that we deploy and about how we set the hurdle for it, and we make the best choices for capital deployment with the highest returns. But we're ambivalent as to which route.
Brilliant. Thank you.
Thank you, Alex. The next question today comes from Tim Barrett from Numis. Tim, please go ahead. Your line is now open.
Morning, Tim.
Hello. Morning, both of you. I had my two questions on food and beverage, if that's all right. Slide 25 is very helpful, and looking at the detail, it looks like within the last 2 months, that minus 4.6 has been a little bit better in the last few weeks, even though VAT has gone back up to 20%. So specifically, I just wondered, what have you done on price in recent weeks as the VAT's gone back up, and what you intend to do this year was the first question.
Yeah, you're right. It has gone back. It has gone up as we've gone into the new year, slightly on the chart from 25. I think it's about 5% back on pre-COVID levels as we speak at the moment in the first seven weeks of the new trading year. I mean, we have done lots of initiatives, quite broad initiatives to bring back both demand and to make sure we've got the right focus on margin as well. We've launched new spring menus. And reconfigured some of the menus, both for supply chain issues and for pricing. But equally, we've been very focused on ensuring that we remain competitive and we don't just lose covers at the expense of gaining price. So we're managing it in a sort of relatively dynamic way. We are lucky in restaurants because we do trade on seasonal menus, so we can always reissue and reprice if we think we've got issues. We've also done a lot of work on drinks and drinks pricing, and there have been some price rises, as you've probably seen in beer and other drinks products, which again is helping us improve our margins. Hemant, do you want to add to that, though?
I think it's worth mentioning as well that across the value end of the pub market in particular, a lot of discounting has come out over the last couple of years post-COVID, and that's meant that net pricing is actually it's been a bit higher across the market, and we've obviously, been part of that as well. And with the new menus that we've put in, we've simplified a lot of the ranges, but also some of the pricing as well to make it a lot more hard hitting to drive demand.
Okay. And the sort of follow up there was just, is there anything material to call out in terms of the joint sites, the separate pub restaurants, and those integrated restaurants within Premier?
No, nothing to call out at all.
Okay. Thanks very much.
That's right. Thanks, Tim.
Thank you, Tim. As a reminder, if you would like to ask a question, please press star followed by 1 on your telephone keypad. The next question today comes from Joe Thomas at HSBC. Joe, please go ahead. Your line is now open.
Hi, Joe.
Good morning. Good morning, both of you. Just a couple of things, please. The first one, sort of longer term, I just wanted to ask you about your returns on capital targets. And obviously, the capacity outlook's getting better, the estates being optimised, new hotels getting more operational leverage in them, pricing is good. I'm just wondering how conservative, to put words in your mouth, you might be being on those long-term return on capital targets, which I would have thought might be edging up by now. And then, secondly, just would like a little bit more visibility, if at all possible, on the white-collar office demand. I know you said it's. I think the phrase in the presentation was that it's recovering well. I just wondered if there's any harder data that you could put around it, please.
Right. Okay. I mean, we're not at all uncomfortable with our ROCE, with our return on capital position. We've guided for Germany 10 to 14%, which is our sort of mature returns profile for Germany, albeit that in maturity they trade below that until they've reached mature levels. And so, that will be part of the makeup of, I guess, sort of slightly less productive capital, or not capital that is operating at its full level as part of the group. So as Germany gets bigger, there'll be a bit of that, which means that we're comfortable with our overall returns profile returning to pre-pandemic levels, which we've been always comfortable running at.
Yeah.
I haven't got anything to add more to. We certainly won't be notching it up at this stage.
Yeah, I think that's exactly right. I mean, we've talked to getting back to group returns to 10 to 13% ROCE overall, with them obviously depending on the maturity of the German business. That is roughly the level, at the high end of that level, where we were pre-COVID, and our first stage is going to get back to that level before we decide to take that any further.
Yeah. Okay. And on business demand and office worker trends, that's about 25% of our revenue, about half our business, which is half the main revenue. And obviously the other half is blue collar or tradesperson demand, which has stayed very robust throughout the whole COVID because it's essential business travel, effectively. But office worker demand it hasn't been. We think, demand was subdued until September, and then we started to see increasing levels of demand from September onwards. We clearly had a bit of a blip during the early part of the year, the back end of the year and early part, when we had that Omicron wave for a short period of time, and then it got back to pretty fast recovery thereafter. We now see midweek bookings, which is the predominant white-collar worker, Tuesdays and Wednesdays. They're all ahead of pre-COVID levels. London's also now ahead of pre-COVID levels as well in the last 7 weeks. So that's a sort of proof point for the business demand. We've worked quite hard on business demand, while we were closed, to make sure we were set up for success. And we've extended our customer reach through an improved Business Booker portal, and we've also widened out the number of travel management companies. But certainly we've seen very good results from the Business Booker portal with people coming through, and we extended credit facilities into SMEs as well, which we put in place during the COVID crisis. So again, another step up there. So we can definitely see average room rate growth across that business booking period now, and we're pretty comfortable with it.
Brilliant. Thank you.
Thank you, Joe.
I'm not sure if we do have any more questions, but we are coming to the end of time. So Bailey, if we have one more, we'll take it. If we haven't, then we are absolutely good to stop because we kept everyone till 10:10 already.
Yeah, we have no more questions currently registered.
That's fantastic. In which case, thank you everybody for dialing in. Any follow-ups, please do let us know, and have a good day, everyone.
Thank you.
That concludes the Whitbread PLC full year 2022 preliminary results conference call. Thank you for your participation. You may now disconnect your line.